Hey, it's Ryan from the Option Income Advisor, and this is the trade of the day for July 16th, 2021. And what we've done recently is we've got a couple different series going on. We've got one on dividend stocks, and we've got one that we just started yesterday that's called generating, income from growth, or utilizing growth to generate income. And so what that is we've got two totally different types of stocks that you can utilize the triple income wheel for, right? And so on one side, you've got, stable dividend stocks that obviously make sense, for the triple income wheel. Those are more on the low volatility side, but they do pay a dividend. And then you've got higher growth stocks that don't pay a dividend, that you essentially manufacture a dividend by selling puts, and those are typically on the higher volatility side, right? And so you've got these two different types of businesses that are in different stages of their growth that both can do very well in this strategy, right? And so the key is just being able to adjust for the volatility. So for the higher growth names, you're going to want more margin of safety. And when we get into talking about Peloton, that's our trade of the day today. I'll show you. And the whole reason we do these trades of the day is really just to show you the mindset that you need to take, when you look at a trade, for example, and just to show you that you can take pretty much any stock and, find an opportunity as long as you're adjusting for the volatility correctly, right? And so let's take a look at Peloton. Again, this is going to be our, generating income from growth situation, right? This is a stock that does not pay a dividend. And at first glance, a lot of these growth names are not going to show up on your fundamental screens necessarily. And so this one actually has a safety rating of 7, which is good, and I'll kind of show you why. But they're typically low on the value side, right? So when you look at the valuation of a stock like this, right, it's trading well beyond what it should, right? But you're valuing this business right now based on its future, right? And so you're always going to trade beyond your valuation at the early stages that some of these businesses are in. So Peloton is just high level. Again, you want the high level thesis with the triple income wheel. Even though we're taking short-term trades, you want the high level thesis there, because it's a business that you may have to own for a period of time. And so really what you're trying to do is you're trying to target the right price, and then you're trying to target just a stock that you feel comfortable has tailwinds, and you feel comfortable with the business model, and you feel comfortable with the stock over the long term. But what you're doing is you're just taking short-term trades with margins of safety, right? So you can adjust the risk reward in your favor. And like I've been saying, I mean, you can typically get 12% plus a year out of a lot of these stocks without ever owning them, right? And so this stock is one that I love. I'm a Peloton user, and so if you're a Peloton user, you know exactly what I'm talking about. And if you're not, just it'll open your eyes a little bit, as far as just the stickiness of the customer base. But essentially what they do is they sell high-end bikes, cycle bikes and treadmills. And you essentially you can't use the bike or the treadmill without using their software, which costs you $40 a month. But they've got an amazing video library and live instructors, and they just create an amazing experience. They've got great customer ratings across the board. And it shows in their growth, and I'll get into some of their growth numbers here in a minute. But, this is the type of business that's, you talk about disruptors and businesses that are like changing the game. Well, they absolutely changed the game, right? And it came at a time, and, they were popular, pre-COVID, but, during COVID, obviously, it became extremely popular. And a lot of people think that I think the sales are going to fall off, but I would say just from my standpoint, and Peter Lynch always says, you invest in what you know, and I don't always do that, but I think this is one of those scenarios where you do. Like I would never probably cancel my Peloton subscription. It'd be one of the last subscriptions I would cancel. And it's because they kind of got you, right? They got you in a situation where you've spent a lot of money on this piece of equipment, and the last thing you're going to do is cancel the one thing that allows you to use that equipment, right? You might as well just sell the equipment at that point. But and that's where this industry has always had people, just in a situation where, if they're going to cancel, you're kind of admitting defeat. You're admitting that, hey, I'm not going to work out anymore. So it's one of those emotional things that got you in anyway. So it's a phenomenal business. I think it's only scratching the surface, even with COVID. I think you got to kind of look past. They did pull forward some sales, but that doesn't mean that they can't continue to grow, because they're, again, just, I think, kind of scratching the surface on what they can do. So that's our kind of long-term thesis of wanting to be in a business like this. So let's take a look at kind of the short term and say what price makes sense today, and what price can we start the wheel process and sell a cash secured put. So again, the stock's trading around 111. Our strike zone is 83 to 94, and so that equates to a margin of safety of about 15.8%. So we've got about a 16% margin of safety. And what drives that margin of safety are these factors here. So it's volatility and risk. So it's on the low end of our volatility, or low end of our risk spectrum, right? So it's this number is essentially making the margin of safety higher, right? It's negatively impacting that, and that's just because the more volatile a stock is, the more margin of safety you want. And this has been a volatile stock, just as you would expect with kind of the stage of growth it's in. But it has pulled back quite a bit. So what the pullback indicator says is, if a stock has pulled back already quite a bit, that you would need less of a margin of safety. So in this circumstance, this is kind of lowering the margin of safety you would essentially need, because this stock has it's currently 35% off its high, and I'll look at the chart in a second, but it pulled back almost 50% from its high at one point and is now kind of stabilized and started trading a little bit higher. And then EPS is something we always want to watch, because that could definitely affect the margin of safety as well. All else being equal, if we've got earnings risk within the time frame of our option, we're gonna want a higher margin of safety. So that's kind of the lay of the land with margin of safety. So we're expecting we're requiring about a 16% margin of safety to get into our quote unquote strike zone, which is the area that we want to sell a put. And then we always, all else being equal, we want stocks and options that are liquid. And so this liquidity ranking of 10, again, all of our rankings are 1 through 10, as you know. And so this liquidity ranking, it's one of the best out there. It does have very liquid stock and options, as you'll see. So let's actually take a look at the chart. Let me pull that up. So you can see what I'm talking about. So this, back at the low end of COVID, or kind of the starting point of COVID, the low end of the stock, I mean, this thing traded down to about $20 a share, which is crazy, right? And then you can see as COVID kind of took hold, and then, this was kind of the fear of COVID, the stay-at-home situation. People realizing that, hey, this is actually a good company no matter what situation we're in, but COVID actually accelerated their earnings. And then we got to this point where, all kind of tech growth stocks peaked out. And then once, and this was kind of the tech growth scare where interest rates started creeping higher. And so we had a huge sell-off, right? And so that sell-off, took us down into kind of the 100 range. And then, in here we had a situation where, and again, treadmills are kind of, I think, last I looked, I think it was like 3 or 4% of revenue. So not a huge portion of their revenue just yet. But they had kind of a recall with some of their treadmills. And so the initial reaction of the stock was just to sell it off, which it's kind of crazy because yes, it is a growth piece of it, the business, but it currently was not a big piece of the business at the time. So it had sold off, and it kind of right around this kind of $85 level is where it got support, and you can see from that support level, right, we've gone up, and what I like about it is that we actually broke, even though we've come down a little bit from here, we broke through the level that it had kind of peaked at right here, right? So, this was kind of in the 123 range, and I think we hit about 126. So that kind of made a new, a higher high kind of over the short term. But, I kind of look at this as this range it's in. And so if you look at this range, we're talking about like, call it 125, down to say 85. So that's kind of the range it's been trading in. So pretty wide range, but, at least a range we can kind of hang our hat on a little bit, right? And so I would expect that, if we drop down into the bottom half of this range, it would be a good buying opportunity. And so that's where we look at our strike zone, which again was kind of in that range down here below. It was, 83 to 94 roughly. So it's kind of at the low end of that strike zone. So that gives me that confidence that, hey, my strike zone is also, a level that I think is good from a technical standpoint. So that's the chart. And so, one thing I did want to show you, and again, valuation, this company's going to grow into its valuation. So it's so hard to take a look at, what's the proper valuation to look at right now, because the company's been growing so fast, and, my charts here don't even do it justice. So let me just show you. I had this presentation pulled up because it's one of the, when you see a chart like this, where, and yes, you're reading that correctly, they've had 100% annual revenue growth 6 years in a row, right? And so, and again, I think they're still scratching the surface on probably where this business could go. But you can see, 2020, $1.8 billion of sales. And, that's just incredible growth, and again, a lot of this was kind of pull forward, but they're projecting that they're actually going to be able to kind of stabilize, in this higher level of sales. So, 2021 is going to be even higher, and it's this is just a phenomenal chart. You don't see this kind of stuff too often, and this just shows you the growth, right? If you didn't look at a business like this because it wasn't quote unquote stable and it didn't have the fundamentals that maybe you looked for in a screen, you totally missed the boat on some of this stuff, right? And so, just one last chart I wanted to show you as well. Again, this one is just phenomenal growth, and you can see literally quarter after quarter of subscription growth. And this is, again, that's a 107% compound annual growth rate over the last 3 years roughly. But every single quarter they're growing subscriptions. And look, this is the number of workouts their users are doing, right? And this, again, probably a little bit inflated with COVID, but if they can stabilize in some level here and continue to move forward, I think that again this company has a lot of growth left in it. So I think they're probably just scratching the surface. I know they just hit 1 million subscriptions, and they're projecting that their lofty goal is they could do 100 million at some point in the future. But I think if you got into the 5, 10, even 20 million subscribers, this is a much bigger business than it is now, right? So there's a lot of upside is the point. So let's take a look at. I've been kind of long-winded today because I actually truly love this business. It's one of my favorite companies, and it's one of those. It's one of those brand awareness businesses as well. You look at your Teslas and your Apples, And, I would put this right up there, Lululemon, I'd put this right up there with just the brands that people relate to the most and are just, almost kind of cultish about. That's definitely the category this stock fits into, which is obviously good for the long term. So let's take a look at, okay, we're still doing August, right? It's 36 days out. And so if I'm looking at the average monthly yield, margin of safety, and then the delta, again, we can get much juicier premiums with these growth stocks than we can with the dividend stocks. And so I always say, have a balance of these type of stocks where you're getting your income from the growth, right? You're manufacturing your dividend. Versus the kind of more stable dividend stock where you don't need as big of a margin of safety. You got that dividend in there, but it's a nice balance to have both, right? Have half your portfolio in dividends and type of stocks while running the wheel on it, but also have a good mix of these growth names in there. So this. Right here, I would say, in this level, again, our strike zone is 83 to 94. So you can see this 95 is just outside of it, right? Just above it. But my kind of rule of thumb is if our cost basis is within our strike zone, that's kind of where I set the upper limit. So, we're getting roughly $2 a share. So our cost basis would be about $93, so we would be in the strike zone if we did this one. And so, we could do this one to be a little more conservative, be in the strike zone. That's 1%, but that delta is way down at 11. That's almost the conservative portfolio type delta. And so even this one here, the 95, which again, the cost basis will get us into the strike zone. That's a 17 delta. And so that risk reward here where I'm getting 1.7 average monthly yield, got a 15% margin of safety. And by the way, no earnings risk. Okay. This is quite a situation we have here where, we can get this kind of risk reward without having to take earnings risk. So that's kind of nice. So this one would be our base. And again, conservative, I would potentially even go up to the 90, but just for conservative sake, right? We'll do the 85 there because that gets us, the 0.7%, huge margin of safety, delta of 7, and then on the aggressive side, let's go with the 100. This 100 round number, tends to hold. Again, I think the only reason we dropped below that before with this stock was because of that treadmill kind of, situation. And, I think people didn't really know how to react to it. But I think what they've seen with that treadmill that most people, most customers it didn't really bother them. They had the recall, people are still buying the treadmills. I know, I had a recall on my treadmill and, did not take it. I didn't want to send it back. They come and fix it. So it wasn't really an issue for us, at all. But, this one gets us, 2.6, which is, great for the aggressive portfolio. And then, 24, delta with, a 10% margin of safety. So I like all those trades for the aggressive base and conservative portfolios. So that's Peloton. And again, the reason why we do this is, you've got to have these types of companies in your portfolio. And, if you, we do these trades for, educational purposes to get you in the mindset of kind of, going through the process constantly of looking for these trades, because to do the triple income wheel, you need a constant flow of trade activity, a constant flow of ideas. And so, definitely look at our, subscription service, the Option Income Advisor. You can see the website we use for these videos. This is the website you get access to through the subscription. We have over 750 optionable stocks that we feel are the best stocks out there. You have the ability to screen and create your own watch lists and all kinds of good stuff on the website. So check that out if you haven't. And that's our trade of the day. Take care.